Every Monday to Friday, this is Peter Lewis's Money Talk. Money Talk.
Good morning, this is Peter Lewis, welcoming you to my podcast Money Talk for Monday the 10th of July. This podcast is sponsored by Surfing Group, which is headquartered in Singapore and offers online financial services to 30 million customers across 10 countries. Thank you for making this podcast one of the most listened to financial podcasts in Hong Kong. In today's business and finance headlines, US Treasury Secretary Janet Yellen said competition between the world's biggest economies is not a winner-take-all situation and called for both sides to manage their rivalry with a fair set of rules. But she said she was also concerned about new export controls recently announced by China on two critical minerals used in semiconductors, saying the US was still evaluating the impact of these actions. Chinese financial regulators have fined Ant Group 7.1 billion renminbi, that's $983 million for financial violations, but concluding a government-led restructuring for the fintech group almost 3 years after its $37 billion IPO was called off. On Saturday, Ant Group launched a share buyback plan that values the fintech giant at nearly 70% below its proposed IPO price in 2020. Jobs growth in the US slowed more than expected in June and was revised lower for the previous 2 months in a sign the Federal Reserve's aggressive interest rate rises are beginning to cool the labour market. However, a fall in the unemployment rate and higher than expected wage growth highlighted the resilience in the jobs market. The Hong Kong Monetary Authority on Friday relaxed mortgage rules for some properties for the first time since 2009 to make them more affordable. Effective immediately, homes valued at up to 15 million Hong Kong dollars for the owner's own use will be eligible for up to 70% mortgage financing, while those valued between 15 million and 30 million are entitled to 60% loans. But Financial Secretary Paul Chan said that the government is not considering relaxing cooling measures such as the special stamp duty. On today's programme, I'm joined by Alex Wong, Director at Alex K.Y. Wong Asset Management, and Simon Kavanagh, Partner at BDA Partners. Providing a view from Mainland China will be Shanghai-based independent economist Andy Sher. And if you want to get in touch, please go to my website, peterlewismoneytalk.substack.com.
Peter Lewis's Money Talk.
US stocks were choppy on Friday in the fallout from the largely solid non-farm payrolls report, with earlier gains in the S&P 500 and Nasdaq Composite petering out in the afternoon and leaving the two indices lower for the week. The S&P 500 lost 0.33% to end at 4,399, notching a 3-day losing streak. The Nasdaq Composite dipped 0.1% to close at 13,661. The Dow dropped 187 points, or 0.6%, and that took it to 33,735. The Nasdaq led on the week, managing to get back to break-even at one stage Friday before the late-day profit-taking left it down 0.9% over the holiday-shortened week. The Dow lagged on the week, losing 2%. The S&P 500 fell 1.2% over the same period. The CBOE Volatility Index, the VIX, was up over 9% last week. That's its first weekly rise since May. And Alibaba added 3.4% in New York after its affiliate company Ant Group was fined $984 million by Chinese regulators, but signalling an end to lengthy government-led restructuring for Ant. Treasury yields were all higher on the week, with the most notable feature being the Friday reversal in the short end. The 2-year yield ended 5 basis points higher over the week, but it fell back below 5% to 4.95% Friday after reaching 5.12% on Thursday. That's its highest level since 2007. The 10-year yield jumped 23 basis points higher over the week to 4.07%, and that led to a pronounced steepening of the yield curve, with the 2 to 10-year steepening to minus 88 basis points after inverting to a record minus 110 basis points earlier in the week. Hong Kong stocks hit a 5-week low. The Hang Seng Index fell 167 points, or 0.9%, to 18,366. For the week, it lost almost 3%. In mainland China, the Shanghai Composite fell 0.3% to 3,197. The Hang Seng Mainland Bank Index declined 1.2%, edging towards its lowest point since November 2022. The sub-index lost 10.5% last week after Goldman Sachs lowered its rating for Agricultural Bank of China, ICBC and Industrial Bank to sell. citing investor concerns over the bank's exposure to local government debt. ICBC, ABC and Construction Bank tumbled by between 7.5% to 13.6% over the week, their worst 5-day loss in at least 12 months. A newspaper owned by the Chinese Communist Party, the Security Times, pushed back against the Goldman report, saying in a front-page editorial that pessimism towards China's banking industry shouldn't be encouraged and is largely a misinterpretation. You can get more details on the latest market movements in my daily newsletter, which you'll find at peterlewismoneytalk.substack.com.
Every Monday to Friday, this is Peter Lewis's Money Talk. Peter Lewis's Money Talk.
On this Monday morning, let's welcome our guests. We have with us Alex Wong, Director of Alex K.Y. Wong Asset Management. Morning to you, Alex.
Hi, morning, Peter.
And also joining us, Simon Kavanagh, who is partner at BDA Partners. Welcome, Simon.
Morning, Peter.
Let's start with Janet Yellen's visit. US Treasury Secretary Janet Yellen said competition between the world's biggest economies is not a winner-take-all situation, and she called for both sides to manage their rivalry with a fair set of rules. She made her comments Friday in a meeting with Premier Li Qiang during her 4-day visit to Beijing, with the goal of finding areas of common economic ground and rebuilding bridges between the world's two biggest economies. Ms Yellen said that in her meeting with the Chinese government, she made clear that actions we take to protect our national security are designed to be narrowly targeted. They're not premised on straightforward national security considerations and not undertaken to gain economic advantage over China, she said. And the US Treasury Secretary told Premier Li, we seek healthy economic competition that's not winner-take-all, but with a fair set of rules that can benefit both countries over time. And she said the US seeks to diversify rather than decouple from China. So, Alex, this long-awaited visit, was it a success?
I think it's difficult to call. I think the market actually would still be skeptical about the China and US relationships because I think in the U.S. the sentiment towards China is still quite negative and still see China as a threat. So I think people probably would not will this progress as a very big progress, I think. But the recent restrictions on exports on China rare earth actually I think will play an important part. And I think people would probably may think that would help to ease some tension, because I think China actually is quite strong in rare earth resources. So I think that probably would make the Western world taking a step back.
You said, Alex, last week, and in fact the week before on this show, you said you need to see two things happen before Chinese equities can rebound. One of those things was an improvement in the geopolitical situation and an easing of tensions between the US and China. Is this it? Is this enough? Is this going to be the catalyst for Chinese equity markets to rebound?
I think this is not enough, but another thing actually is happening. I think that the end financial thing actually is helping. So probably we would have some momentum. Actually, today would be quite crucial because, first of all, we have probably a support in renminbi emerging, and then we probably would expect the government to take a step back in controlling those private enterprises. So I think that would probably help. Market is still skeptical. I think the rebound on Friday night actually is not strong enough. Probably is propelled by short covering mainly. But the development today actually would be crucial. So I think we need to see whether it will develop into a sustained recovery in Chinese equities.
Okay, well, I'm going to talk more with you in a moment about this ant fine and what that means for investors. But Simon, let me ask you that the Biden administration has been trying to demonstrate that its China policy isn't just a continuation of the Trump administration's sort of open hostility to Beijing. So did Janet Yellen succeed in that mission, do you think, in sort of at least rebuilding some relationships?
I think she did partly. But what you've got is essentially two streams going on. There are the economists and sort of on Yellen's side, and they want to work together. And there's a recognition that essentially the two economies are incredibly interlinked and interdependent. And then there's the political side, which is more Blinken geopolitics, and that still remains very negative. And unfortunately, I think the geopolitics will overshadow any progress that they make on the economic front. But what you've got at the moment, China's really fundamentally, particularly in comparison to the US, very weak economically at this point in time. And I mean, it doesn't actually benefit the US to really sort of deteriorate that situation any further. I mean, they actually need a fairly, I suppose, strong but functioning Chinese economy working well. They can differ on various areas, and yes, there'll still be those sort of national security concerns over semiconductor, and there'll be a bit of tit-for-tat relationships. But I mean, the Chinese economy is weak. The two economies are still very linked, and I think Janet Yellen's trip is to try and make sure that there's a dialogue and there's at least an understanding, even if they don't always see eye to eye. And I think from that point of view, it helped, but it's not going to change the overall fundamental relationship.
I mean, you say the politics is going to ultimately trump the economics because there's still these big areas of disagreement, aren't they, that haven't been resolved. But presumably we shouldn't underestimate either these new lines of communication that are now open on the economic front, and particularly as China seems to see Janet Yellen as perhaps the more pragmatic of the people in the Biden administration.
Fully agree. And I mean, communication is really key to everything, whether it's on the military side, on the politics, or in the economy. The more they talk, the more they understand each other and their positions, even if they choose to differ, then that will only be a positive.
Let me ask you both, do you buy the arguments that the US is advancing here, which is that diversifying supply chains is not the same as decoupling? She went to great lengths to try and say the two are different. And she was basically saying it's a sensible response to what we saw during the pandemic for countries now not to rely on a single country for its supply chains, needs to diversify, but that doesn't mean we're decoupling. Do you buy that argument? That's the one they're trying to make, I think, isn't it?
I think it's a bit of spin to some extent, when it's a result of the US realizing that it's overly reliant on China, and China perhaps is not politically going in the direction that the US would like, and therefore they need to diversify. So it's spin calling it not decoupling, but diversification. But it's to some extent perfectly logical.
What do you think, Alex? So did you buy into this argument that, ultimately, countries, not just the US, but they do need to diversify supply chains, but that's not the same as disengaging from each other?
Yeah, I think that argument actually makes sense and logical. So you cannot say this is wrong, but I think it depends on the cost and the magnitude and the cost benefits analysis. Probably they are not only basing on the economic decisions. But anyway, I think the diversification actually makes sense.
And what about the second argument that the US is trying to make when it talks about these sanctions that it's imposing on Chinese companies? It says these US sanctions are very narrowly targeted on areas that only affect national security, and it's not about trying to hold back China's economic growth. Do you believe that? Are these narrowly targeted sanctions?
I don't really feel that they're narrowly targeted. I mean, they're all technology-based, but I think the US goal is to slow down the development of China on the technology side, whether it's semiconductor or elsewhere. And, I mean, China will catch up eventually. It's just a case of how much lead time the US can give itself. And will it develop new technologies by the time China's actually developed internally the old things? So, but I mean, again, it's not entirely unsurprising or unfair. I mean, there's always economic competition between large companies, countries, whether it's the US and China or previously US and Japan. So it's not entirely surprising, but I don't think it's fair to say this is a very narrow competition.
The thing that undercuts their argument is that there's a very large number of Chinese companies that are on the US entities list now and have sanctions against them of some sort. I heard that nearly every single Chinese company in the semiconductor space now has some sort of sanctions on it. So it sort of doesn't sound narrowly targeted when you look at the evidence, does it?
Yeah, and I think Biden's now also got on his desk a new bill to limit investment into China by US companies, and I think that'll be fairly broad as well. And it'll just contribute to the deterioration on the investment relationship.
Alex, do you buy this argument? These are narrowly targeted sanctions only related to national security?
Even though probably this is narrowly targeted, but this is targeted at the critical part, I think. So this is a very precisely targeted areas, and this is very critical for Chinese development in technology. So I think it still hurts a lot. So this is still bad for China.
And presumably it's going to get worse because there's other restrictions being looked at, like, access to cloud computing, controls on investment into China. So it looks like it's going to get worse before it gets better.
I think you need to see whether the countermeasures by China would have effects, because of China restrictions on where oil actually probably would help. I think the Western world actually would need to see whether it would be impacted a lot by these restrictions.
Do you think this metals ban on these two metals, rare earth metals, germanium, gallium, that are used in semiconductors, is that going to have a big impact?
I think it could give some bargaining power on the Chinese part. So we need to see how the Western world will react. I think this is quite critical.
What do you think, Simon? I mean, it certainly shows, doesn't it, how these raw materials now are becoming sort of strategic in global markets. They're really now at the centre of policy actions, these metals that no one had even heard of until a week ago.
Well, these rare earths have been an issue for a number of years, and ironically, that they're not actually that rare. They're just incredibly in minute quantities where they're found, and so it's very resource intensive and environmentally unfriendly to actually mine them and extract them, which is why primarily it's been done in China. I mean, some of these metals, they do exist in the US, but you're just not going to get the environmental approvals to do some of the mining practices that are required and some of the waste products that are generated. I think as Alex says, this is leverage. So where gallium and germanium go, those products, some of them will need to end up back in China. So, and I mean, yes, they're putting restrictions, and maybe it's primarily directed at the US, but a lot of European countries use these as well, and they go into EV vehicles, which are obviously in great demand in China too. So again, you've got the sort of global economic environment, and everyone's still quite interconnected, and products and raw materials move back and forth. So it's really leverage.
I mean, its gallium prices jumped 27% last week, so this is a double-edged sword for China, isn't it? Because if it drives up the prices of these, all that's going to happen is other countries, it becomes more economical for them to go and mine this and produce it. And as you say, there are other sources of these metals. Yeah,
and what you'll find is middlemen will start to come in. So while China may be restricting some exports to the US, because really what they're putting in place is a sort of licensing regime for these exports of these existing products, so that they know where they're going, and fine, they may restrict it to the US, but it can go to Southeast Asia and maybe then get re-exported to Europe and then end up in the US that way. So people will find a way, but it'll make things more expensive.
Okay, well, let's turn our attention to Ant Group. China's financial regulators have fined Ant Group 7.1 million renminbi. That's almost $1 billion, $983 million for financial regulations. But they've indicated this concludes a government-led restructuring for the fintech group almost 3 years after it started and its IPO was called off. China's central banks and security regulator said in a statement on Friday that Ant had corrected most of its significant issues and was now entering a period of normalised regulation. And then on Saturday, following the news of the fine, Ant Group launched a share buyback plan that values the fintech giant at nearly 70% below its proposed IPO price in 2020. It's going to repurchase up to $6 billion in shares, which is about 7.5% of its equity interest. So, Alex, that brings us back to last week. The second thing that you said you wanted to see before you would reconsider going back into Chinese equities was a change of attitude towards China's private companies and more signs that they were going to be supported and encouraged by Beijing. Is this it? Is this what you've been waiting for?
I think this is a step in the right direction. But I think the market may not conclude this is the sufficient steps, I think. First of all, I think the buyback proposal actually is not encouraging, because I think Alibaba taking part in that buyback is a negative sign. And
why is that? Why is that a negative?
I think because Alibaba is taking that valuation and exited some of its interest in Ant. So that means and actually I think Alibaba actually has strong cash flow and I think people would like Alibaba to take part in Ant. So this is a bad steps for the markets, bad side for the market, I think. So probably the impact may be minimized by this one, limited by this one. So anyway, I think the market probably may not still convinced that the control on private enterprises would be like the what happened a decade ago. So I think we probably would still be a bit concerned, but this is a right step, and we probably will see short covering to take part, and we probably may see some momentum in Chinese shares. But we need to see whether market is convinced and we have further momentum. First of all, I think, and then second of all, I think the last week price action in Chinese consumer names actually is very bad. So I think that this is also another part of concern.
So it sounds like from what you're saying on those two issues that you wanted to see some strong signals for. This is encouraging, but I think you're saying it's not enough, is it?
Yeah, this is encouraging, but not enough. I think the market probably would be a little bit skeptical as right now.
Simon, what are your thoughts on this? The regulators signalling that this is the end of the crackdown, and they're also saying the same for Tencent as well, because they got a fine for their payment group, Tenpay. Do you think the regulatory crackdown is now over and China's ready to start being more positive and supportive of its private companies?
No, unfortunately, I don't. I think this is really the start of the new era, and it's just a reminder of how stringent and sort of how much scrutiny these companies are now under from a regulatory point of view. And I mean, you look, Ant's lost $200 billion in value because of this regulatory review compared to where it was a few years ago. And I mean, that's value that's disappeared, and it's a new regulatory environment. And I don't see much on sort of positive for the Chinese private sector in the next few years based on the current environment.
I suppose the worry is also what comes next, because we've seen some of these things come completely out of the blue, haven't they? Like, for example, this crackdown on consultancy firms. It sort of suddenly came from Beijing, and I suppose investors' worries is it that something else might come up, even if it's not the tech side anymore. There could always be something else that affects private companies or foreign companies.
I think the consulting firms were slightly different. That was more dressed up as a sort of national security concern, foreign investment, putting a hindrance on that. The Tencent, Alibaba, and all those reviews, that's really Beijing looking to curb any undue influence that individual companies have, and making sure that the government is very much firmly in control of all aspects of the economy. And that, I think, will ultimately be, I mean, that's really China's biggest problem at the moment in terms of how do they stimulate the economy when they are trying to micromanage everything.
Alex, as Simon was mentioning, we've finally got a price tag now, really, haven't we, on what this regulatory crackdown has cost. In the case of Ant Group, over $220 billion, 70% of its valuation. I mean, it's just a huge, huge cost, isn't it, this 3 years of investigation. Do you think Alibaba could get back anything to where, not in terms of valuation, but just in terms of its business and what it's able to do? Can it get back to where it was before, or is it now a totally different company?
I think it would not, I think. First of all, the valuation would not be bad. It would not be back to where it was, because I think, as Simon pointed out, people don't like the restrictions or the concern of the Chinese government on the big private enterprises, on data park and on the economic influence. So probably they would be limited by this one. And then for earnings, I think right now its cloud business actually is challenged by those telecom companies, and which would be helped by the Chinese government, because they probably want to have the control on data. So cloud business actually probably would be tilted towards those telecom companies. And then for e-commerce, I think the market actually is much more competitive. So I think it would be very difficult for Alibaba to get back to its highest, to the best days.
I suppose even if this regulatory crackdown has come to an end, the environment now is very different, isn't it, for tech firms, because you've got all these new rules about data protection and competition. I presume it's going to be difficult for Ant or any other firm, for that matter, to thrive in that type of environment.
Yeah, because for Ant, before the crackdown, it is expanding the leverage of the Chinese societies. So I think that's why the government does not like it, because this is making the economy more vulnerable, actually. So I think that's why this is a target of the crackdown.
Simon, you mentioned the economy. Obviously, that's the big issue. Everyone seems to be waiting for some form of stimulus to come. We haven't seen it so far, but the government sort of keeps holding out hope that something might be coming down the pipe sort of fairly soon. The next key meeting, if you like, is the Politburo that meets later this month, that maybe could give some more specifics on what these stimulus measures could be. But what does the economy need? Because it looks like the property sector is really in this prolonged slump at the moment, isn't it? So what can be done to help the economy?
I mean, I'm not entirely sure. I mean, they've got very few monetary levers available to them. The interest rates are very low. They've got a very high underlying debt, both centrally and also at local government levels. They're not going to be able to sort of do an infrastructure spend to get themselves out of this. And what they really need to do is encourage domestic consumption. All the savings that people squirreled away during COVID, during the lockdowns, and changing people's overall sentiment so that money is spent and perhaps on consumer products, coming up with a little more innovation so that people have something new to spend their money on, with domestic tourism and services, again, a little more flexibility and freedom. But my concerns there is because the central government takes such a tight control over where investment is directed and where it sort of takes place, and the companies are not free to make their own decisions, really, and everyone's looking over their shoulder wondering whether their decisions are going to be sort of approved or sanctioned or sort of frowned upon. I think China and Beijing's got really quite a difficult proposition on their hands, which is why, going back to sort of Janet Yellen's visit, I think they are more open now than they were perhaps 12 months ago to sort of a more open economic dialogue with the US, because China really does need some help.
Alex, we're going to get the first half economic data in about 10 days, GDP and all the usual activity data. If it comes out bad, do you think this is what could prompt the policymakers to really come up with some real support measures, get out the big bazooka?
Well, I think the support measures actually are quite limited, and the old tricks actually won't work. I think if you do some more government spending, actually the market will not like it, because China actually is already quite advanced in infrastructure and don't need too much investment in those areas. And the housing market actually would be quite difficult. And I think also the aging populations and the behavior of the Chinese people actually is still quite unfavorable for business. Because they actually spend not enough, and then also the birth rate and marriage rates actually are declining. So I think the people are pretty concerned about that. I think probably some sort of immigration is needed, but I think the Chinese actually don't want to expand in that area.
I've heard talk that some people are saying, some economists are saying that China's entering a balance sheet recession. This is what Japan went through, wasn't it, in the 1990s, where people don't borrow money anymore because they're concerned about their house prices, the outlook for economic growth, so they're focusing on trying to reduce their debt. Is that the problem now? Do you both think we're in a balance sheet recession on the mainland?
I think they're not necessarily a balance sheet recession, but certainly sentiment. And so psychologically, that's the problem. People need to feel more positive about the future. I mean, one of the things I was reading over the weekend is there's an enormous amount of money tied up in mutual funds that are going to be released from their lockup periods over the next couple of months. And these have, because the stock market's performed so badly, the expectation is there's going to be an awful lot of outflows from these funds and from the stock market, and that's going to drag things down there. which is to some extent entirely out of the government's control, and it's just another one of the dampening effects that's going to come along. I mean, overall, if you compared China to Japan in terms of overall debt levels, I mean, China, could spend its way out, but I mean, as Alex says, I mean, it doesn't need more infrastructure, it doesn't need more property. What it needs is a little more investment and innovation within its sort of domestic enterprises, and a little more consumption from the population, which requires positive sentiment.
So it may be that we're going to have to get used to the fact that China's growth is slowing, and the priority for the policymakers isn't trying to boost growth, it's trying to restructure the economy. Yes.
And I mean, the unemployment is probably the single biggest cause for concern, I would think. Needing to find jobs, I mean, find the population shrinking, but I mean, there's an awful lot of youth unemployed, and that's a problem that needs to be solved. Otherwise, they become disillusioned and sort of disappointed, and if they don't feel that they have a future, it becomes a bigger issue.
Okay, let me finally get your thoughts on a couple of features of the markets over the last week. Alex, the first thing was this big surge in the yield curve that we saw, the US Treasury yield curve. US yields all rose across the board, but sort of the middle end, 5-10 year, rose far more than the 2 years. So that's helped the yield curve steepen by about, 30 basis points or so over the last few days. What's that telling us? Is there a message there?
I think the market actually is still waiting for a long recessions, and probably I think they would have it later on. I think, and I think the stock market actually probably would be more polarized, because if you those tech companies actually may still have more support, because the price actually depends on the long-term outlook. But I think those traditional companies actually may be under pressures. So I think the U.S. market generally probably will already hit a short-term resistance and may correct a little bit for those, especially for those traditional businesses.
Simon, we've almost been waiting as long for a US recession as we've been waiting for Chinese stimulus. But do you think that it was very noticeable what happened in the Treasury markets last week? And some people say that they take the inverted yield curve as a recession signal, but other people say that's not enough. What you need is for it to invert and then for it to go back steepening. Well, that's what we're seeing now. So is this a sign now that maybe finally this sort of 14 months of interest rate rises are starting to impact the US economy?
I mean, it will at some point, but everyone's just sort of wondering about the when. And I mean, really, all the pundits have been wrong in terms of how this year has panned out. I mean, the stock market has done far better than expected. And I remember, just a few months ago, we were talking about how we'd reckoned that US interest rates had already leveled off at that point. And now they're sort of going up again. By expectation is another 0.5%, so another 2 rate rises. And I mean, the recession or the slowdown will come, unless we throw out all our economic textbooks. But when is really a question that no one actually has an answer to. I mean, I see that most of the analysts are forecasting that the S&P will end up at the end of the year lower than it is now, sort of either flat or lower. There's only a handful that are saying that it'll still continue to go up. So people think the peak is being reached, but I mean, they would have said that back in January.
Okay, finally, Alex, just one feature of the local market I wanted to ask you. This big fall in Chinese banks that we saw last week following the Goldman Sachs report downgrading 3 of them because of their exposure to the property market. It's quite unusual, isn't it, that you see the Chinese government actually specifically try and push back on an investment bank's piece of research, which suggests they're rather concerned about it. But what's your thoughts on the banks?
I think the banks actually are always a concern for investors because of its asset quality. And right now, Goldman pointed out the local government debt issues. So it is very difficult for those banks to rebound, I think. But Goldman defended as saying they are only suggesting a reshuffle within the sector. So I think that is not helping. I think people would still concerned about the asset quality. And if you want to buy into China, actually, right now, those consumer names would be more attractive, because if China need to rebound, I think those consumer would be would be better than the banks.
Okay, Simon. So it seems like local government debts, that could well be one of the big focuses for the second half of the year.
Yes. It's whether we have a sort of a tipping point, whether there's going to be a trigger with any particular province or local government that stumbles, whether Beijing has to step in and actually sort of backstop a run on any bank. We'll have to wait and see. Certainly, I think from the Goldman report, fine, they're looking at the fundamentals and the actual data from the banks, and they're going, well, hey, if we compare this to any other Western bank, yes, it's a sell. We can put our money elsewhere. But, I mean, realistically, I don't think any of the Chinese banks are going to be allowed to fail or struggle. They've got a lot of debt that they need to sort through, but, I mean, they've had that for a number of years now.
Okay, well, thank you both very much. Great to hear your thoughts. Have a good week ahead. That's Simon Kavanagh, who is partner at BDA Partners. Alex Wong, director of Alex K.Y. Wong Asset Management.
Peter Lewis's Money Talk.
I'm joined now by Shanghai-based independent economist Andy Sher. Morning, Andy.
Good morning, Peter.
Let me ask you first of all about Janet Yellen's 4-day visit to Beijing, designed to try and open at least some lines of communication between economic and financial officials, and to stabilise the relationship between the US and China. Do you think it was a success?
Didn't make much progress. Just the perception of talking, trying to reassure the market. I think that maybe there's a bit of positive effect from there, but there's no substance.
I mean, she talked a lot about supply chain. She was trying to make the argument that diversifying supply chains is not the same as decoupling, that the two countries, remain economically bound at the hip. Do you think that hit home? Do you think it's a sensible argument that it does make sense for countries to diversify their supply chains, but it doesn't mean that they're de-risking or decoupling?
Well, I think that any country can do whatever it wants to do, and the U.S. can do whatever it wants to do. It's been talking about this for 5 years. Mm-hmm. So if it's not doing it, it means that it can't. So I don't think that it will pursue the Chinese government about anything. I think the reality is that the U.S. is imposing more and more tech restrictions, and with the clearly stated goals of slowing China down.
You think that is the case? Because they deny that, don't they? They say these sanctions, these restrictions on the tech sector are very narrowly...
It's obvious now. It's you look at the restriction on chips, it's clearly to... initially it was to target a mobile phone, Huawei's mobile phone business. Mm-hmm. I think that... and it's the military does not need small chips, okay? Mm, mm. And then there's now they're talking about more restrictions on AI chips, basically the chips made by NVIDIA, because they want to slow down AI development.
And we've got more.
That's clearly stated.
Yeah, and we've got more coming, haven't we? We're going to have an investment ban. We're going to have maybe a ban on Chinese companies accessing cloud computing. So it does sound like that this is having quite a big economic effect already on China.
No, it's not an economic effect. It's really on it's on tech development because that AI research does use a lot of cloud services.
Mm-hmm. Well, what do you make of China's response that they announced last week to this, which was to restrict the exports of certain minerals that are needed in semiconductors like gallium and germanium? Do you think that's significant?
Well, it's just a kind of a symbolic gesture to show that China is willing to fight back. Mm. That I think the U.S. thinks that because the U.S. buys from China, so a lot more from China, so China doesn't have much bargaining power. So China is trying to demonstrate that it can do something. So I assume that more will be done soon.
So it sounds like from what you're saying, I mean, foreign investors have been pulling out of the Chinese equity market and waiting. One of the things they're hoping for is to see signs of an improvement in the geopolitical relations between the two countries. But it sounds like from what you're saying, you don't think this is enough. It doesn't go far enough to really change the overall direction things are moving in.
Well, I think it's not possible for significant improvement because there are fundamental differences. China is developing its military because it believes that it needs a blue water navy to protect its trade. And now the ocean-bound trade is multiple times of the U.S. And an Anglo-Saxon navy dominates the oceans like it has been for 400 years. And China cannot live at the mercy of Anglo-Saxons. So that obviously China wants to develop a global navy capable of protecting its trade.
So this means that
I think that then when the Anglo-Saxons want to accept that, and Beijing is still kind of struggling on why Anglo-Saxons are so vehemently opposed. I think that the Beijing does not understand that Anglo-Saxons' prosperity and security originated with the naval dominance, and they still feel that way. So that is an existential challenge to Anglo-Saxons from their perspective. So I think Beijing still does not understand that yet. So I think that this means that fundamentally we are headed for some kind of a confrontation.
You think so? So this could be something like the South China Sea, maybe, where
much greater. I think that, and you look at how the West screamed about China's military development. It started with Australia. It was way before the pandemic, and I think Australia, obviously, as an Anglo-Saxon country far away, felt the most vulnerable about an alternative naval power. So just like when Japan rose 100 years ago.
But this is
after Japan was the Russian Far East Fleet, and the U.S. started developing this plan, so-called Operation Orange, to defeat Japan. It took 40 years to work out. There's no doubt something like this is happening now.
This is very different, isn't it, to really the West's last, or certainly the US's last set of trade disputes, which was with Japan in the 1980s. At that time, although Japan was a rising power economically and starting to dominate trade, it never wanted to develop a big navy or a military.
I think that the issue, people get confused. No, Japan was never. Japan was an occupied country and still is. So I think the economic dispute was significant, but not like what's going on with China today. China is 10 times the Japan size. It's entirely different. And I think that the Anglo-Saxons want the world to stay this way and to be managed by them. And security guaranteed by them. So China needs to operate within that framework. So I don't see, I think that Chinese didn't appreciate how strongly Anglo-Saxons would react. They thought that China thought that China got bigger. They must have more say in its neighborhood, and it should have a Taiwan back. And obviously, without U.S. backing, Taiwan would negotiate with Beijing for sure. Okay, and that issue will be settled peacefully. So that is the kind of they say we are asking for this. But I think that Beijing didn't understand that East Asia is the center of the global economy, and Anglo-Saxon dominance actually is all about East Asia. Controlling this part of the world means controlling the whole world. So to them, this becomes a global struggle for global domination.
So it sounds like then that the key issues between the two countries remain unresolved and are not going to get resolved based on what you say. Let me ask you about the Ant Group fine. The Chinese regulators have fined Ant Group nearly $1 billion, but said now that their 3-year sort of crackdown, if you like, is coming to an end, and that Ant is going to shift to more normalised supervision, is what the regulators said. Is the tech crackdown now over?
I don't know. I'm not sure. I think that the country is trying to make private businesses feel more comfortable, because they've been feeling very insecure for a bunch of years, and the crackdown on tech companies was kind of a symbolic on government's attitude towards private businesses. So there is a softening in tone, but in terms of substance, I'm not sure. I think tech companies with the scale and the reach are considered threats to the political system. So they need to be tamed. That means that they need to become small. So I think Alibaba has this plan of splitting. I don't know when it's going to happen. But for these companies, the business model is based on reach. You make a little bit of money from everybody, and you have this reach. You can take. That's why you become very profitable. So it's reach is essential. Like Google, like Amazon or Apple. It's these companies need to be profit motive drives them to become very, very big, to become monopolies essentially. And then they become threats to the political system. Just like in the United States. The United States now, they have a disproportionate influence over public opinions. And they actually regulate public opinions. And in the Chinese context, that means that you're competing against the Communist Party. That is just no. I think the party has not figured out how to resolve this problem, that you want these tech companies to be strong, to be innovative, but also they don't pose any threat to you.
But these companies have become smaller now, haven't they? Because, as you say, Alibaba is splitting up into 6, and if you look at the share buyback that Ant is doing, it's valued now 70% less than what it was 3 years ago at the time of the IPO. So that they have become smaller, haven't they? But can they still thrive now in this new environment?
No, in terms of valuation has come down, but in terms of the business reach, I'm not sure yet. You look at everybody uses Ali's this payment system, and also the online shopping system, the platform. So it has this enormous access to data, and social data in the private hands are basically not acceptable to the political system.
Let me ask you quickly before you go about the economy. We're at the end of the first half now. We're going to get GDP data for the first half of the year in about 10 days' time. Also, investors still waiting for some stimulus from the government. The Politburo now is meeting later this month, so investors hoping that they might see something from that. Are you hopeful that we might see some sort of action from the Chinese government to back up the words on the economy?
No, I don't think so. I think that but the government will talk about a stimulus to give people hope, and sometimes to make a gesture like cutting interest rate by 10 basis points. And the reality is that Chinese economy has accumulated lots of excesses over the past 10 years, mainly for political reasons. Before the last party congress, I think the government had a reason to stimulate, to keep it going until the political transition completed. It took 10 years to complete the political transition. And from the previous era, completed to a new era, now that transition has occurred. So the political incentive for keeping it going, regardless of the cost, is gone. And then we have the problems that have accumulated are so big, like the property sector. To peak at 10 billion square meters under construction. Now, in the last 2 years, they shrunk by about 10%. So it's got a long way to go. So there's no way that the government wants to stimulate in a property sector and make it bigger again. Then you create a bigger problem for yourself down the road. So I don't see why they would be doing that. Now, if they let the property market adjust, that means the economy will struggle for a number of years to come. So that's a reality.
Okay, well, it's interesting to hear your thoughts as always, Andy. Thank you very much indeed for that. That's Andy Scher, who is a Shanghai-based independent economist. And thank you very much for listening this morning. If you want more information on any of the stories we've discussed today, please take a look at my daily newsletter, which you'll find at peterlewismoneytalk.substack.com. Tomorrow on the show, I'll be joined by Asian fund management industry consultant Stuart Aldcroft, James Wong, Chief Executive Officer at Cathasia Securities, and our US economics correspondent, writer and broadcaster Barry Woods. See you tomorrow.
Money Talk